Something unusual just happened in the U.S. housing market, and most people haven't noticed it yet. The largest mortgage collapse in American history has now entered what analysts are calling Phase 2. And this phase is different from anything we've seen in the past 3 years. This is not about rates going up anymore. This is not about buyers disappearing from the market. Phase 2 is something more serious. It's about the system itself beginning to crack. Forced price adjustments, rising inventory, mounting financial pressure building inside the mortgage market from the inside out. And if the data continues moving in the direction it's currently heading, we could be entering one of the most consequential transitions in American housing in decades. So today, we're going to break down exactly what's happening, what the signals are telling us, where the cracks are forming first, and what this means for anyone with money, a mortgage, or a decision to make about property in the near future. To understand why this moment matters, we need to go back to where this all started. Between 2020 and 2022, the U.S. housing market experienced one of the fastest and most aggressive price surges in modern history. Interest rates were sitting near historic lows. Mortgage demand exploded. Buyers flooded the market. Bidding wars became routine. And lenders were issuing mortgages at record volume, pushing money out the door as fast as the applications came in. Home prices in major metros climbed by 30, 40, even 50% in some cases, over just a 2-year window. It was one of the most compressed price acceleration events ever recorded in American real estate. But then the Federal Reserve began raising interest rates, and it did so aggressively. Mortgage rates, which had been sitting around 3%, climbed past 6%, then 7%, then beyond. The affordability math broke almost overnight. Monthly payments on the same home nearly doubled, and just like that, the market froze. That was Phase 1. Sales collapsed. Buyers stepped back. But here's the critical part. Sellers didn't move either. Homeowners locked into ultra-low mortgage rates refused to sell, because selling meant giving up a 3% mortgage and stepping into a 7% one. So inventory stayed low. Prices held, and the market entered a kind of suspended state, a standoff. But standoffs don't last forever, and the data is now showing us that this one is starting to break. Let's start with affordability, because it is still the most important number in this entire story. Right now, the cost of buying a median-priced home in the United States requires a monthly mortgage payment that is dramatically higher than it was just a few years ago. In many major cities, we're talking about payments that have more than doubled compared to 2020. When you layer that on top of stagnant wage growth and elevated consumer debt levels, what you get is a shrinking pool of qualified buyers. Fewer people can actually afford to get into the market, and that matters enormously, because housing prices are ultimately set by what buyers can and will pay. When the buyer pool contracts, price pressure builds from below. It doesn't happen instantly. It happens slowly, then all at once. And right now, we are in that slow phase. But the numbers suggest we are not going to stay there. Now look at transaction volume. Existing home sales have dropped to levels that, in any other context, would be described as a recession-level contraction. The number of homes changing hands each month has fallen sharply compared to the highs of 2021 and 2022. And this matters beyond just the real estate industry. Low transaction volume means price discovery becomes difficult. Sellers list high because they think the pandemic prices still apply. Buyers refuse to bite because the affordability math doesn't work. And the market sits in a frozen state where neither side blinks. But here is the key dynamic that most people miss. That freeze creates pressure. It doesn't release it. Every month that passes with low sales volume, with sellers holding tight, with buyers on the sidelines, is another month of financial pressure building inside the system. mortgage holders who need to sell for personal reasons, investors whose carrying costs are rising, landlords dealing with higher insurance, higher taxes, higher financing. That pressure accumulates, and eventually it forces action. Which brings us to the third signal. Inventory. For the past 2 years, the dominant narrative in housing was that inventory was too low, and that was true. But the trend is beginning to shift. In several U.S. regions, active listings have started to climb. More properties are hitting the market. Some of these are sellers who have simply run out of patience. Some are investors looking to exit before conditions worsen. Some are homeowners facing financial circumstances that give them no choice. The increase is not dramatic yet, but the direction of movement matters, because inventory is the mechanism through which price adjustments actually happen. When supply rises while demand stays weak, sellers begin competing with each other. Listing prices get cut, days on market extend, and the negotiating power shifts from sellers to buyers. We are beginning to see early versions of this dynamic emerge in specific markets across the country. And where it goes from here depends largely on how much more inventory enters the market over the coming months. Now let's talk about geography. Because housing corrections almost never happen evenly, they start in specific places. And then, if conditions are right, they spread. In the current cycle, the early stress is most visible in the Sunbelt markets. Cities across Florida, Texas, Arizona, and parts of the Southeast that saw explosive migration-driven price increases during the pandemic are now starting to show signs of strain. Inventory in several of these markets has risen meaningfully. Days on market have extended. Price reductions are becoming more common. In some Florida metros, the data shows active listings running well above where they were a year ago. Meanwhile, expensive coastal markets like New York and parts of California are experiencing a different problem. Not necessarily rising inventory, but dramatically falling transaction volume. Sales are grinding lower, even as prices remain elevated on paper. That disconnect between prices and volume is itself a warning sign. Because prices that aren't being tested by transactions aren't real prices. They're asking prices. And asking prices and selling prices can diverge significantly when conditions shift. So what does Phase 2 actually mean? Because that's the phrase that's starting to circulate among market analysts and housing economists. And it's worth defining precisely. Phase 1 of this housing correction was primarily about the affordability shock. Rates went up. Demand collapsed. But prices didn't fall because supply also disappeared. The market seized. Phase 2 is what happens when the forces suppressing supply begin to weaken, when sellers can no longer afford to wait, when investors begin to reassess the math on their portfolios, when the financial pressure that has been building inside the system for the past 2 years finally starts to show up in listing behavior and price adjustments. Phase 2 doesn't necessarily mean a crash. It means the adjustment that Phase 1 delayed is now starting to happen. Slowly, unevenly, but in a direction that matters for anyone making real estate decisions right now. And the causal drivers behind this shift are worth understanding clearly. Mortgage rates remain historically elevated relative to the last decade. Many homeowners who purchased at or near the top of the market are carrying very large loan balances relative to both income and current home equity. The equity cushion that was protecting many of these buyers from financial stress is thinner than it looks, because values in some markets have already softened from their peaks. At the same time, the costs of holding property have risen across the board. Property insurance premiums have surged dramatically in high-risk states like Florida and Texas, driven by climate exposure and reinsurance market dynamics. Property tax assessments have caught up in many municipalities that were slow to adjust during the rapid appreciation period. And for anyone using variable rate financing or who needs to refinance, borrowing costs remain punishing. Each of these pressures individually might be manageable. Together, they are slowly changing the calculation for millions of property holders across the country. For real estate investors specifically, the shift is particularly significant. The investment thesis that drove enormous capital into residential real estate over the past decade was built on three assumptions. Prices would keep rising, rental income would cover carrying costs, and cheap financing would remain available. All three of those assumptions are now under pressure simultaneously. Price appreciation has stalled, and in some markets reversed. Rental growth, which surged in 2021 and 2022, has slowed considerably in many metros as new apartment supply has come online. And financing costs have gone from a tailwind to a serious headwind. Investors who are running the numbers on their portfolios right now are finding that the return profile looks very different from what it looked like 2 years ago. And when institutional and individual investors begin to exit positions, even gradually, that adds supply to markets that are already seeing demand weaken. That dynamic is one of the quiet forces building behind Phase 2. For potential homebuyers, this environment creates a genuinely complicated set of decisions. On one hand, the intense bidding wars and over-asking offers that defined the 20, 21, and 2022 markets are largely gone in most areas. Buyers are seeing more listings sit longer, more price reductions, more seller concessions on closing costs and repairs. The negotiating balance has shifted. On the other hand, the fundamental affordability problem hasn't gone away. Mortgage rates are still high, and unless rates fall significantly, buying a home still requires a very large monthly payment relative to incomes. So even if prices drift lower, affordability may not improve as much as buyers hope unless rate conditions change. Anyone evaluating a purchase right now needs to stress test the math at current rates, not projected future rates. For current homeowners, the picture is more nuanced. Those who locked in ultra-low rates between 2020 and 2022 remain in genuinely strong positions. Their monthly costs are fixed and manageable. Their equity, even if somewhat reduced from peak, is still substantial in most cases. But homeowners who bought near the top of the market in 2022 with larger loans and higher rates are in a more exposed position. If life circumstances require a sale in the near term, the combination of softening prices and high transaction costs could put pressure on equity positions. This is why the emerging consensus among housing analysts is that Phase 2 will not look like a sharp collapse. It will look like a slow, grinding adjustment. A market that moves sideways or drifts lower over time, with pockets of more significant stress in the most overextended markets. The U.S. housing market is not just a sector, it is one of the foundational pillars of the American economy. When housing moves, everything around it moves with it. Construction employment, banking and credit markets, consumer spending tied to home equity, household net worth across tens of millions of families. The transition into Phase 2 of this mortgage correction does not guarantee a dramatic crash, but it does signal something important. The period of suspended animation, where prices held up through sheer lack of supply, is coming to an end. The market is beginning to move again, and the direction of that movement is not upward. Understanding where we are in this cycle, what the data is actually showing, and what comes next is not about predicting disaster. It is about being honest with yourself about the environment you're operating in. Because in markets like this one, the people who navigate well are almost always the ones who read the signals early, understood what they meant, and made decisions based on reality rather than hope.